Vehicle sales continued to accelerate last month with 12% more vehicles sold than back in July. Year-on-year sales were 37% higher. Year-to-date, 25% more cars, buses and trucks have been sold than last year. Joining me in studio for more on this are Tony Twine, Senior Economist at Econometrix, Sydney Soundy, Managing Executive at Absa Vehicle and Asset Finance. Gents, thanks very much for coming in today. Sydney, you were in last month and we were talking about July's growth, and of course that was a bit softer, 3.6% monthly increase from June, 20% year-on-year, but it looks like it's starting to gain a bit more momentum now.
We're seeing some momentum. This month was actually a good month. If you look at year-to-date growth, we're looking at 25% higher than the same period in the last year. So that's significant if you compare those two numbers.
Tony, were you surprised at the extent of August's growth? Because of course we have the World Cup done and dusted. There's no more refleeting by those car rental companies. So were you expecting a bit of a slowdown coming through?
No, we knew that there would be a pre-buy on the passenger car side ahead of the emissions tax kick-in, which happened yesterday. But I must admit that every little bit that I'd coaxed out of the arithmetic to add on to the car numbers was left way behind by reality. So it was an upside surprise on particularly car side, light commercials and the heavier commercials, both pleasantly strong.
Of course, yeah, because Tony, you've got light commercials up 9% year-on-year, heavy commercials up 33% year-on-year. Now, the emissions tax doesn't really apply to them, does it? So that's quite correct. So those were, if you like, plain vanilla numbers. There was nothing boosting them artificially. Sydney, the emissions tax, do you think that's going to put a bit of a dampener on sales of some vehicles going forward from here?
I think the way that it's drawn vehicle sales into August will probably leave both the supply side and the demand side a little more tired in the last 4 months of the year. We should note, however, that consumers must shop carefully, particularly during September, because there are ways and means by prepaying the tax to have avoided, not evaded, avoided the emissions tax for customers during as long as stocks outside of the OEMs or the manufacturers' bond storage last during the early weeks of September. So shop around, guys.
Sydney, your view on that, do you think there's going to be an impact on sales going into the rest of the year with that tax? Do you think people are going to be avoiding it rather than evading it, as Tony says?
Steve, no. I think the impact will not be that high. If you look at the average increases to prices, we're looking at between 2 to 3%. So some of the vehicles, for example, the increase will be 1%, and the highest we think will be about 4%. So in effect, there will be other factors that one needs to take into account to determine whether or not growth is going to be experienced in the next few months.
So what sort of factors will you be looking at, Sydney?
Well, for example, the current strikes that we are experiencing, but also the strike that we experienced in the motor manufacturing environment. Now we're having strikes on the component supplier side. So that will have an effect in terms of the vehicle supply, which will also then impact on the number of vehicles sold.
Would you expect some supply constraints going forward from here, Tony, due to these strikes?
Yes, I would. We saw Volkswagen South Africa yesterday announce a closure of their Uitenhage plant because of lack of components. We've got metal components, we've got tyres, where a strike is also hampering the supply side. So yes, I rather think that September could get a double dose of the after effects of the preemptive buy in August on the demand side, plus supply side constraints.
So just looking at August sales, and I'm thinking particularly of the heavy commercial and light commercial here, what does it tell you about the state of the economy if companies are buying new trucks?
The heavier you go up that particular league, the heavier the commercial vehicle, the more insight you gain into what's happening in the gross fixed capital formation spend of the country. And right at the moment, it looks like people who were expecting that to fall down in a heap after the final whistle of Soccer World Cup have been proven wrong. Certainly some industries and sectors that supply things into fixed capital formation are struggling, particularly building companies and the large civil engineering organizations are short of orders at the moment, but the rest of the fixed investment environment is looking quite healthy given the expectations of perhaps 3 or 4 months ago.
So what sort of growth in applications for finance are you seeing over at Absa at this stage, and what sort of percentage of those are you granting?
Well, we saw an increase from July to August of over 9% in terms of new applications received.
Is that good?
That is good, because if you compare to last year, we didn't have as many applications as we're now having. If you compare that, we're talking close to 54% increase if you compare the same month last year to this month. So, yeah, I think August was a good month. But as Tony indicates, we're cautious as we go into September.
And how about the health of your customers? Are you granting more of those applications that you are getting? Is the customer getting back on his feet? Because of course we do know that household debt still stands very close to that 80% high we saw recently.
Yes, Steve, we're granting more than we used to grant, but from as early as February, March, the same sort of percentages of approvals are being experienced. The quality of the application has remained pretty much the same. We're seeing about 50% of applications coming through requiring or without deposit. So that indicates to us that there's still an impact on the consumer out there. Although in terms of the quality related to the affordability, the ticket value, we're seeing that the ticket value is increasing a bit, and that is also a result of the lengthening of the contract period that customers are applying for. So whereas we used to see customers applying for periods less than 60 months, we're now seeing much more customers coming through to apply for vehicle finance over 60 months, up to 72 months.
Tony, how do you think an interest rate cut, if we get one next week, will help the markets? And of course, how will it perhaps mitigate some of this new tax that's coming in as well, if you are looking for finance on your vehicle?
An interest rate cut obviously lowers the cost of borrowing, and at the same time makes consumers, or perhaps business borrowers, it kind of elevates their affordability levels. So if you're paying less interest on a monthly basis due to a lower interest rate, you probably qualify in Sydney's vetting systems more easily than you would have done last month. So it would help alleviate, particularly on the household consumption side, where a cross-sectional analysis of the passenger vehicle markets so far this year tell us that the household buyer of new cars is still struggling to get into the market, and most of the success already mentioned by Sydney this year has come from the business side of the demand market.